If you look at the macroeconomic environment and look at the things that drives gold, you know, lower interest rates or negative real interest rates and higher inflation and weaker dollar and softer economy, meaning the Fed's going to start cutting rates and a weak stock market. Well, that's not the environment we're in right now. You and I, or I'll speak for myself, I may say things aren't quite as strong as they appear, and we may look ahead and say they're going to get worse. But the plain fact is, if you look at the macroeconomic environment right now, it is a negative environment for gold.
Gold took a breather after hitting a new all-time high last week. But the rally's drivers remain in place, including strong central bank buying, ongoing geopolitical uncertainty, and the likely Federal Reserve move to cut interest rates in the coming months. Gold and silver prices are trading sharply lower in midday U.S. trading Thursday on worries about lessening global demand for metals. Gold prices hit a more than 2-week low, and silver dropped to a 2.5-month low. Heavy profit-taking and week-long liquidation from futures traders are featured today. Based on his analysis, renowned financial expert AdrianDay acknowledges the potential for worsening economic conditions, but emphasizes that the current environment does not support a significant rise in gold prices. He acknowledges that recent gold movements are driven by central bank purchases and concerns over dollar weaponization, not general economic factors. This explains the lack of increased investment in gold stocks. In worst-case scenarios, gold is still the asset to own. Gold benefits from events that don't favor other assets like shares and bonds. It, therefore, has a proven capacity to act as a diversifier. Meanwhile, Adrian expresses that the sentiment in the West remains quite negative, as evidenced by lower deliveries from mints and reduced premiums on coins, indicating weak demand. He points out that major gold ETFs are still experiencing net outflows, with GLD seeing only about 8 days of net inflows in the last 3 months, despite a rise in gold prices. Citigroup analysts have also projected that gold prices could surge even higher, potentially reaching $3,000 per ounce within the next 6 to 18 months. This outlook is supported by increasing inflows into gold-backed ETFs, reflecting growing investor confidence in gold as a safe haven asset. Now, we present the clips of AdrianDay's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Well, the sentiment in the West is still pretty negative, right? You look at the coin dealers. You look at deliveries from the mint are lower. You look at premiums on coins, they're lower. These are reflections not of a strong market, but of weak demand. Then you look at GDX and the other gold ETFs. The gold ETFs in North America and Europe are still seeing net outflows. So you look at a GDX for the last 3 months, and I mean, my gosh, we've only had about 8 days where there have been net inflows. I mean, it's astonishing in the last 3 months, even though gold has moved up. And the same goes, which is even perhaps more surprising to me, with the gold stocks. You look at, did I say GDX? I meant GLD. Sorry.
No, you said GDX, yes, but you meant GLD.
I
right?
meant GLD, the physical gold. Now we'll switch to the gold stock ETFs, of which the GDX is the largest. And in the last 3 months, it's been $1.3 billion of outflows. $1.3 billion of outflows. VanEck reports the inflows and outflows on a daily basis. Some days there is nothing reported because it was too small. But the days when they actually invested or had to sell, there's only been about 7 days in the last 3 months where there have been net inflows. It's astonishing. And the net inflows have been, by and large, pretty small compared with the net outflows. Now, we manage a gold mutual fund, as you know, for Peter Schiff, the Euro Pacific. I'm not allowed to talk specifically about our fund, but let me just say that when I talk to other gold mutual fund managers, everyone, so you can infer what's happening to us, everyone is seeing outflows. It's astonishing. Now, these outflows may not be dramatic, but they're steady outflows. And I think there's a lot of things going on, but we can say the ordinary investor in the US is not a believer that the market has turned yet. I think the plain fact is that, if you look at the macroeconomic environment and look at the things that drives gold, lower interest rates or negative real interest rates and higher inflation and weaker dollar and softer economy, meaning the Fed's going to start cutting rates and a weak stock market. Well, that's not the environment we're in right now. Things aren't quite as strong as they appear. And we may look ahead and say they're going to get worse. But the plain fact is, if you look at the macroeconomic environment right now, it is a negative environment for gold. And so the ordinary investor perhaps sees that. And what's been driving gold in particular, of course, are things, central bank buying because of dollar weaponization, Chinese investors buying because they're worried about the banking system. Well, these people are not worried about the macroeconomic environment. That's not why they're buying gold in the first place. So it's not illogical that gold is moving up to new highs and we're still not seeing a flood of people pouring into gold stocks.
During the interview, AdrianDay expressed that the Federal Reserve is in a challenging situation regarding interest rates. He suggests prolonged high rates could strain households and businesses, increasing their financial burdens. Adrian also notes that Powell may be cautious about his legacy, avoiding premature rate cuts that could lead to a resurgence of inflation. Part of the Fed's hesitancy to cut rates is its lack of confidence that inflation will continue to decline to the 2% target, rather than settle at a stable 2.5% to 3%. Maintaining monetary policy at a restrictive level would increase the probability of hitting that number, but at the significant risk of causing undue damage to employment and the economy. However, Adrian observes that unlike during Paul Volcker's era, Powell cannot double interest rates to combat inflation because of today's high economic debt levels. This limits the Fed's ability to take drastic measures. Let's get back to the interview.
I wasn't able to listen to what Jerome Powell said today. I mean, look, the truth is, as everybody knows, and Jerome Powell himself knows, they are in a no-win situation. In my view, they're in a no-win situation. If they keep rates too high higher for longer, they really risk the economy and unemployment and, the threat to the federal government finances, of course. And the problem, I think it's important, sometimes if you put it into a human story term, it's easy to understand. The family that bought a used car, 5 or 6 years ago, and they probably paid, I don't know what used car loan rates are, to be honest with you, but let's say LIBOR plus 5. Would that be reasonable?
That probably sounds about right. Yeah.
So 7 years ago, they would have paid 6%. Now that clunker is dead, and the family has to go out and buy a new car. Well, now LIBOR plus 5 is, 10%.
Yeah.
So the rate that they are paying has just gone up. The monthly payment has just gone up dramatically. And this is a family that might be living, paycheck to paycheck. So they could just about make the payment on the last car. Now it's suddenly gone up by 60, 70%. The company that borrowed money 5 years ago at LIBOR plus 2, 2.5 plus 2, 4 years ago, 5 years ago, could borrow 4.5%, 5%. Now they're borrowing at 8, 9%. I mean, and that money is going to roll over. So the higher for longer mantra, the longer we go on with interest rates where they are, then the more households, the more corporations who may be good credits or they may be poor credits, but the more households and corporations suddenly come into the higher interest rate environment. I mean, if a company, let's say a company termed out all their debt 5 years ago, the higher interest rates haven't affected them.
No.
Until their debt matures. And they have to roll it over. Then it suddenly affects them all at once. So, the Fed is in a very difficult position. Jerome Powell, clearly, we know this anecdotally from people who know him, Jerome Powell is concerned about his legacy. He does not want to go down as, everybody says, the other Arthur Burns, which is a little unfair on Arthur Burns, but he doesn't want to go down as a person who, cut interest rates too soon and allowed inflation to blossom. And I suspect that if Jerome Powell keeps interest rates higher a little longer than he should, but manages to bring inflation down, he can retire when it's time for him to step down. Even if the economy is in a little worse shape and unemployment is a little bit higher, he can say, I killed inflation. The truth is he cannot kill inflation in the way that Volcker did. We forget when Volcker came in, the Fed funds rate was already double digits. So Arthur Burns wasn't quite so bad. It was all, well, there was Miller between the two, but so we already had the Fed funds rate, I think, at 12%, but it was certainly double digits when Volcker came in, and Volcker doubled them, more or less doubled. Powell simply cannot double rates from now. I mean, he got way ahead of inflation, Volcker. We simply can't do that right now because of the debt in the economy.
Gold has largely surpassed expectations this year, breaking out of a trading range around the 2,000 level in January and forging onto new record highs around and above the $2,400 mark by July. That puts gold among the world's best performing assets year to date. Given the current economic environment and central bank actions, do you believe gold will continue to rise, or will other factors keep its growth in check? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.